The cryptocurrency world is once again shaken. Prices are falling, investors are panicking, and headlines everywhere are screaming about another crash. But the question on everyone's mind is this: are the big players really leaving the market? Or is this just another storm in the never-ending cycle of crypto volatility? Let's break it down. Bitcoin, the king of digital assets, has taken the lead in this downturn. For months, Bitcoin held strong above key support levels, giving traders hope that a new bull run was on the horizon. But now, it has slipped, dropping below critical points that once looked unbreakable. The fall triggered panic selling, and thousands of leveraged positions have been liquidated in just hours. Billions of dollars vanished from the market almost overnight. Ethereum, the second largest cryptocurrency, hasn't been spared either. Known as the backbone of decentralized finance and NFTs, Ethereum's sharp decline has also dragged down the DeFi ecosystem and token projects that depend on it. Solana, Cardano, Binance Coin, and other major players followed the same painful path, losing as much as 20 to 40% in just a short span of time. But here's what really has the market nervous: the behavior of institutional investors, the whales. On-chain data shows huge outflows from exchanges. Wallets that belong to large institutions are moving funds into stablecoins, or worse, selling them off completely. Why does this matter? Because institutions were supposed to be the future of crypto. When they poured billions into the market during the last bull run, Bitcoin soared past $60,000. Now, if those same giants are quietly leaving, retail investors fear the worst. If the whales are leaving the ocean, what chance do the small fish have? Of course, the crash doesn't exist in a vacuum. The world economy is going through its own struggles. Inflation remains high, central banks are raising interest rates, and global markets are jittery. When investors are nervous, they run to safer places, like gold, bonds, or even just holding dollars. Risky assets like crypto are usually the first to get dumped. And don't forget regulation. Governments around the world are stepping up their efforts to control the crypto space. The U.S. Securities and Exchange Commission is cracking down, labeling many tokens as unregistered securities. In Europe and Asia, new rules are being proposed for stablecoins, exchanges, and DeFi platforms. With all this uncertainty, it's no surprise that big investors would rather step back and wait for clearer skies. Meanwhile, retail traders, the ordinary people who once flooded into crypto with dreams of overnight riches, were also losing confidence. On social media, hashtags like #CryptoCrash and #BearMarket are trending again. Fear, uncertainty, and doubt, better known in the crypto world as FUD, are everywhere. Influencers who once shouted, "Buy the dip," are now warning followers to stay cautious. The result: trading volumes are dropping, liquidity is drying up, and price swings are more violent than ever. But here's the twist. Not everyone sees this as the end. Some long-term believers argue that this is just another cycle, the kind that Bitcoin has seen many times before. History shows us that after every crash, crypto eventually bounces back, sometimes to levels even higher than before. For those who believe in the technology, this downturn is simply a chance to accumulate at lower prices. And the truth is, innovation in crypto hasn't stopped. Developers are still building. Ethereum has already shifted to proof of stake. Bitcoin's Lightning Network is making transactions faster and cheaper. Layer 2 solutions are expanding, and Web3 projects are growing. Venture capital is still flowing into blockchain startups. So while the prices might look ugly now, the industry itself continues to evolve. One interesting detail during this crash is the role of stablecoins. Investors are moving heavily into assets like USDT, USDC, and I. These coins, pegged to the US dollar, act as a temporary shelter in the storm. It doesn't necessarily mean people are leaving crypto entirely, it could mean they're just waiting for the right moment to jump back in. Still, stablecoins aren't risk-free. Regulators are questioning whether their reserves are truly safe. If trust in stablecoins breaks down, it could trigger yet another wave of panic. Geopolitics also plays a part. In countries facing inflation, political instability, or restrictions on moving money, crypto remains a lifeline. People in places with weak currencies still turn to Bitcoin and stablecoins as a way to protect their savings. For them, it's not just about profit, it's about survival. So where does that leave us? The current crash is a reminder of how brutal and unpredictable crypto can be. One moment, millionaires are made. The next, fortunes vanish. For big investors, it may be a chance to reset their positions. For small traders, it's a test of patience and conviction. Is crypto heading into a long winter, or is this just another dip before the next rally? Nobody truly knows. What we do know is that the story of cryptocurrency is far from over. For some, this crash proves that digital assets are too unstable to ever become mainstream. For others, it's simply another chapter in Bitcoin's long journey toward global adoption. One thing is certain, whether you're a believer or a skeptic, crypto never fails to keep the world watching.